Today, it's time to get real. Hello again, it's Martin North from Digital Finance Analytics. Welcome to our latest post covering finance and property news with a distinctively Australian flavour. Today, I'm joined again by Tony Locantro. Hello, Tony.
G'day, Martin. How's it all going?
Pretty good. A lot going on at the moment, and I know you've been busy too.
Oh, extremely busy. I just spent the weekend in Sydney. I was actually staying on the northern beaches at Narrabeen, and I went out to Penrith to visit my kids. So I got a good feel that Pittwater Road hopefully is not going to become Parramatta Road by the sea. And I was looking at some developments in Dee Why, and I was hoping that Dee Why doesn't become Chatswood by the sea. So I just think it's a mess, what's happening.
Right. And when you say it's a mess, I guess there's a couple of dimensions to that is. Firstly, the amount of development, but secondly, what's happening to home prices.
Well, certainly. I remain steadfast in my $640,000 target on the median price. I know that it has been falling, and there was a slight bounce in the clearance rates. And there's been a bit of cheerleading about that, but if you look at the numbers year on year, they're way down. And the way I see it is anyone who is thinking of selling should use this little period where there is an uptick in clearance rates and talk of an RBA rate cut to get the hell out of their property. If they're feeling slightly stressed, you've got to sell. You've got no choice, because we're still at 11 times price to income, and unless I'm completely wrong, which I doubt, it's not a new paradigm at all. And I guess if you've got one chance to pick up, surely there's an idiot out there that doesn't listen to us, doesn't read Twitter, just relies on the Daily Telegraph and Domain for their information. You might get lucky and pick up someone who's willing to pay too much. But I was just looking at it from take a whole view of things. It looks pretty grim, and I can understand how families are feeling. And I thought that your mortgage stress figures and the postcode analysis was frightening.
Yeah, well, it does get really, very real when you actually look at real households in real postcodes, right? And sort of, as I do with the data that I collect, it isn't just a sort of a theoretical high-level issue. It's actually real people, right? And I can tell you that real people are actually under significant pressure at the moment, and not just in the western suburbs of Sydney, but more broadly too. And it's the old, double hit, really. Income's not growing, cost of living growing, mortgage is extremely large, and as you say, highly leveraged. And the equation isn't working for many people. So I think your advice, which is, if you can get out and you need to get out now, is probably right. My surveys are showing me that there are more people now looking to try and put their property on the market over the next month or two, to try and sell into that very, very slight twitch upwards that we've seen in terms of clearance rates, although it's hardly noticeable. But of course, they're doing it at a time when prices are continuing to fall. So it's a really tricky equation. And I guess, as you say, you want people who haven't been following what we've been saying, but have been following the mainstream media, because they're the people perhaps who will still be daft enough to want to buy in the current situation. But I don't think that's going to last for much longer.
No, and I have the mantra, if you're going to panic first, because if you have a real estate agent come to you and say, well, this is worth this much, and all they do is present you with sales evidence, so you need to be the first one. And I guess it's a nerve-wracking time, because a lot of families, I can imagine, are too scared to get 3 appraisals, because they're worried suddenly that one of them's going to look stupid, either the husband or the wife that's told them to pay $1 million for something that's worth $600,000. And I guess a lot of families are going to stick their head in the sand. And it's like the ATO. You can run, but you can't hide. Eventually, they catch up with you.
Yeah, I think you're right. And the other point I'd make is that we seem to be crossing a bit of a Rubicon in some postcodes now, where prices have dropped 20% or more from their peak. And I actually think that's a very important, crossover point, because people are prepared to wear a little bit of capital loss because, of course, prices ran up considerably. But a lot of people have bought over the last 18 months or 2 years, and so pretty much all of their savings have now evaporated. And as I think we've said before, the problem, of course, in a falling market is it's not that the bank and you share the downside. You take all the pain. So if prices drop 20%, you lose your 20%. The bank still has their equity in the mortgage. So it really is now a very important time. And as we see more household sectors and postcodes drop below that 20%, I'm expecting to see an acceleration of falls, in fact.
Yeah, well, the investor loans figures were absolutely off a cliff. And I liken that even to the lithium sector in Australia, which went nuts. Once you remove speculators from the equation and they're not leveraged, you have a disaster waiting to happen. And even the quality lithium stocks have pretty much been cut in half. And I think the same thing's going to happen with the property. There's just not enough people coming in to buy. And that little last run up in the Sydney property, it's just a rampant case of FOMO.
Yeah, no, you're right about that. And of course, the issue is now it's spreading beyond, just Sydney as well, right? So we're seeing now Melbourne, in fact, diving quicker than Sydney. I'm seeing some negativity now in places like Adelaide and Brisbane. And even Tassie, which is sort of, the last state standing, looks to me to its weakening as well. In my latest surveys, the price expectations across Australia have really dived to a very low level, including in Tasmania. So, almost nobody in my surveys is saying, we expect prices to be higher in 12 months' time than lower. And that's a big change from even six months ago, where people were still quite confident. So I think we are yet to see that fully working through. And of course, the credit momentum, if you look at the latest data, which came out just a couple of days ago, showed that we've seen a considerable drop in new approvals, not only for investment, but also for owner-occupied loans now. And first-time buyers are stepping back as well, because a lot of first-time buyers in my survey say, why would I buy now when I can wait a year and get a cheaper property or a property in a better area for the same price? So I'm afraid that there's a lot of different factors that I think will drive this further south.
Well, I think if you have a look at Perth, briefly in 2006, we were the most expensive capital city in Australia. Now, if you look at some figures, we're the cheapest. And it's all to do with money flow, it's all to do with speculation and perception. And Perth, we've been in a dreaded bear market now for 5 years. And I liken it to being sandpaper to death, and there's still more downside to come for Perth. And even at, say, 5.5, 6 times price to income, on a historical basis, we're still overpriced.
Yeah, no, I've been watching Perth very closely because there's a little bit of momentum from first-time buyers in Perth, and some owner-occupiers who think it's now an interesting time to buy. But the delinquency rates, of course, are still very high over in the West. Suncorp, of course, disclosed that they had a problem with one of their securitized offerings, the one from 2010. Yeah. And the delinquencies on that particular pool was 3%. And I'm seeing a 3% delinquency rate in various pockets around Western Australia at the moment. And that's not all to do with the mining areas. It is partly. But it's also slightly more broadly, it's the second order effects, it's the broad economic impacts of the slow market for a long period of time, and wages not rising, rental streams also dying as well to an extent. So in a way, I think that Perth is a leading indicator of what we need to expect to see in the other states in the next 2 to 3 years.
Well, absolutely, but we didn't have that momentum on the way up, and at the moment, we're still, as I said, overpriced. And if anyone thinks that you can have 80% gains in Sydney and Melbourne and only lose 10 to 15%, I think they're delusional.
Well, it's funny, people are still talking about soft landings and how clever the Reserve Bank has been to manipulate this just perfectly, and everything's going to be fine. Except I'm not convinced.
No, and there's now talk about 2 rate cuts this year down at 1%. And again, what price are we going to look at the Aussie dollar then? Is it going to have a 5 or a 6 in front of it? And yeah.
Well, I think that's important because if the Aussie dollar does slide, and of course there is some capacity for that to happen, the Reserve Bank's already said that they're prepared to let the dollar slide lower. But of course that has a significant impact on overseas investors who are thinking potentially of putting money into Australia to support the banks, right? 20% of funding comes from offshore funding. The issue I've got is if the dollar does go lower, liquidity, I think, is going to become quite a significant issue for the banks, who are still needing to run these 90-day funding cycles all the time just to keep their books alive. So it's going to be quite tricky, I think.
Yeah, I just don't think at the moment the RBA has got anywhere to go. I think Australia as a country, based on our rampant consumerism, our buy now, pay later mantra, it's funny how the share prices of Afterpay and another company called Split It have pretty much peaked at a time where I think we're heading into potentially a nasty recession that I think will be quite deep, because we've just had this debt binge for so long. We've had a generation without a recession. Families are leveraged to the hilt. And I think a lot of these economists who are saying, look, there's no bubble in Australia, we've got no issues, are the types on $500,000 a year, the kids are at a private school, and they haven't got a worry in the world. But how I get my instinct comes from, I consider myself to be an upper middle bogan. I started out in the police service, I became a broker, my income's lumpy, I have to manage my personal balance sheet. And I was actually a police officer during the last recession. I know a lot of your viewers, some of your viewers might not have even been born. And the amount of financial and personal stress on a family cannot be underestimated at all. And I saw that video you did with Eddie Hobbs on Ireland. I think we're going to be in for a world of pain. I know domestic violence levels will increase. Families will start getting desperate. You just can't say, well, I'll go and drive Uber or get a pizza delivery job. And I think, I've said it before, that I think insurance fraud is going to become quite an issue. I think people will be quite happy to take the risk because there's going to be so much financial distress.
Yeah, well, you touch on a couple of very important issues. I guess the first one is this sort of debt other than traditional bank-related personal credit, right? We're seeing that rise dramatically, and that includes the Afterpay type model, where, of course, they don't actually lend money, they just rely on the existing facilities that exist on credit cards, which is interesting and quite a smart business model, but it still is debt that needs to be repaid. And ASIC did a report quite recently, I think, that said about 1 in 6 Afterpay customers have a problem in making those repayments. So it's quite a significant risk. We're also seeing rises in other forms of consumer credit, and that from everything from payday to MACC, the mid-sized credit, to other non-bank forms of lending. In some cases now, some of those alternative lenders are offering $10,000, $15,000, $20,000 loans at very high interest rates, and people are grasping them because they've got no other option. It's the only way that they can actually, keep things afloat. But as I keep saying, just adding more debt into the mix doesn't solve anything. It just makes the problem bigger later. And certainly the evidence from Ireland and from elsewhere is that as the property cycle swings into negative territory and pressure grows on households, it is the personal debt that builds and pops first, as well as the mortgage debt. But that leads on to significant social pressures and social concerns for households. And I think Eddie's point about, look at it from a social risk perspective as well as just a market and finance risk perspective, I think it's a very important piece of advice.
Yeah. No, in my policing days, it was pretty much mainly drunks. We didn't have the huge ice, methamphetamine problems that we're seeing today. And I know it's going to drive a lot of families to the wall. I mean, I've had periods where I've worried about my own balance sheet. And once you ring a real estate agent and find out you're 150 grand in negative equity, you're then a prisoner. And you've got nowhere to go, and heaven help you if you lose your job. So people don't realise that in the States, your debt is associated with the house, and they don't come after you after that. Now, that makes Australians far more vulnerable.
That's right. So it's full recourse, whatever happens. So even if you sell your property and if there's negative equity in there and you've still got a debt left, that debt stays with you. And the only way you can actually shake that is to ultimately go through some sort of bankruptcy or some sort of other restructuring, which is extremely difficult, time consuming, and somewhat embarrassing to put it mildly as well. Whereas, of course, in many states in the US, you hand the keys back and that extinguishes the mortgage that you had at the time. And some would say, by the way, that the full recourse lending in Australia has made the banks even more willing to lend, because they know at the end of the day that they can effectively drive a hard bargain when it comes to consumers if things go wrong.
Yeah, I think which is inevitable. And actually, it was funny because I have been looking at property prices around, and I started looking at Vancouver. And you think we've got an absolute basket case. I can't believe all the Vancouver prices with more. They've got 8s on everything. Everything's 888, quadruple 8, trying to suck in the Chinese. But for those in Sydney, there's no FOMO. There's no rampant Chinese buying anymore. And suddenly investors are scarce. There's nothing left to support a market priced at 11 times price to income. Interest rates questionable whether they're going to get cut, and an economy on the absolute precipice, Martin, where everyone's maxed out. No one's any capacity to go again. You're not going to be able to reflate the bubble. There's not enough second jobs for people to support. The banker mum and dad's going to collapse because a lot of parents have put up their equity, and it's basically a house of cards. And I see my 45% peak to trough target, as much as I hate to say it, coming off. And I make it pretty clear now that price to income isn't going from 11 to 15 times. We're not going to do what Hong Kong has done. Just get the hell out if you can. Sell all your shit possessions before there's a flood of jet skis, HSVs and FPVs. This is critical stuff. This is the rest of your life. I mean, you don't want to be a slave, a mortgage prisoner till you get an inheritance. Then you've got to rely on your parents to die to get out of it, or your superannuation. But a lot of millennials are sending their parents broke.
Yeah, and one other interesting factor you touched on superannuation. The 2.8 trillion in superannuation. One question that people should be asking is how much of my superannuation is directly or indirectly connected with the property and finance sector? Because what we'll discover is that superannuation fund is also at risk.
Well, absolutely. I actually saw something which I think is ridiculous. A super fund's been established and they bought a house in Stanmore. And a lady who invested in that super fund was standing outside. Maybe she can go and mow the lawns for them. But, I was a police officer in Petersham. I don't find Stanmore a desirable area. I know I'm probably going to insult people, but sometimes you just got to tell the truth.
Yeah, it's interesting because it's that sort of second order effect. So I'm looking at 2 second order effects, right? The first is the fact that households now are spending less because they're got less money to spend and they're concerned about where property prices are going, and we saw that in the GDP number, and I think we're going to see more downward side on the retail end of things. Plus, of course, the construction sector is coming off very quickly. My surveys are telling me that a lot of the traders are now less visible in terms of their future pipeline of work compared with 6 months ago, so they're worried about that. We know that there have been some collapses amongst some developers. I think there were a couple in Adelaide recently, and I've seen others in Brisbane and some over in Perth too. So these are construction companies who are unable to complete the buildings that are currently being built at the moment, so that they're either going to be resold at sort of half finished or just left idle. And then the second point is this sort of feedback loop in terms of into superannuation and, if you like, the other asset class that's big in Australia. And again, I think that's a risk that people haven't fully understood yet in terms of how that all plays through. So at the moment, the banks are saying, no, there's no issues. Default rates are very, very low. We're very well capitalised. Everything's absolutely fine. But if you look carefully, their net margins are still under pressure. The default rates are beginning to rise. Some of the funding questions are still there, although the BBSW is back a bit. And it's not going to take much to be able to tip the banks into a rather different mode. And I think, as Eddie made the point too, once you start seeing prices slide below a certain level, let's say 20%, banks are going to be even less likely to lend. So we've got all of that milling around at the moment. And unfortunately, the Reserve Bank is still saying we don't have an issue. Unemployment will stay low, income will ultimately rise and get us out of jail. And if necessary, we'll cut rates a little bit and do a bit of QE and even slip the dollar a bit. It's like, yeah, but is that really going to be enough to solve the problem?
Oh, it's too late. We've passed the point of no return. I think the property prices, eastern states, even most of Australia, is going to fall. There's going to be pockets where you're going to see a 20% rise, but that'll all be on low volume. And I've seen some ridiculous press, some articles. Actually, my adversary, Stephen Kouk, has put out an article series saying, buy a house now and hold it for 10 years. Well, buy a house now and screw your life for 10 years as far as I'm concerned. I just think that is ridiculous. I don't know where these people think that now's the time to buy a house. This property route really has just come off a ludicrous peak. It was driven by FOMO, fraud, loose lending, low interest rates. But to tell young people now to go in and buy a house and it's your financial freedom, what a load of absolute rubbish. As I said to people today on Twitter, you've got a choice. You can have the Italian or the Greek. So if you look at our surnames, you'll work that one out. But yeah, I just can't believe how stupid we are. These economists who obviously got degrees, don't they know what a speculative bubble looks like? And then they'll say, we're talking ourselves into recession. Well, Australians, we've had this massive debt binge. I know once my wealth effect, once I'm feeling wealthy, I would go to JB Hi-Fi and spend hundreds of dollars. I buy all these shirts I never wear, and then eventually when I'm looking at stuff I haven't even opened, the stuff I've bought, it's ridiculous. And we're just, this rampant consumerism, I think it's going to come to an end, and it's going to be brought down by a correction to a bubble that should never have happened in the first place.
Well, I think you can certainly look at the Reserve Bank. They took rates too low. They allow the credit boom to continue for too long with APRA and the Council of Financial Regulators, because, of course, they were trying to effectively offset the fall from the mining sector. But I'm afraid that over a 10-year horizon, if you think of Ireland as an analogue, people who bought before the crash in Ireland 10 years later are still holding property often with a lower value than the day they bought it. So this is not going to be a short correction. We're not going to suddenly be saved by a flood of migration or really cheap money, in my view. Whatever is going to play out over the next few years is going to be a long, slow grind. And in fact, my modelling is suggesting it's going to be more like Japan. And if you look carefully in Japan, there are some good things about Japan, but there are also a lot of worrying things in terms of the level of long-term house price stagnation. So, yeah, the question you've got to ask yourself if you're thinking of buying into the market now is what happens if prices do not go up? In fact, they do fall. How does that play out in terms of your own finances? And what I've said to many people, and Eddie made this point too when I spoke to him from Ireland, be conservative, right? Really build some buffers, reduce the debt you've got, because this ain't going to get fixed anytime soon.
I think another thing worth remembering, Martin, is that the average mortgage repayment historically in Australia is 9.41%. Now, how is a young couple living out 60 kilometres out near Penrith with an $800,000 mortgage going to pay $80,000 after tax when interest rates revert to the mean? And as sure as shit, that's going to happen over the life of their loan. And so they're out there, they've bought an asset for $1 million, they've paid all the stamp duty, they've got gifts off their mums and dads, they've maxed out their credit cards, and suddenly their asset loses 40% and rates go up because eventually the RBA will realise we're paid all these big dollars to manage an economy, not to appease speculators in Sydney and Melbourne. It is an absolute shit show. I'm actually almost embarrassed to be Australian, even though I've got an Italian surname, Martin. I'm actually embarrassed in this country. We are going to be the laughing stock for generations to come. And you look at it, if you take Hong Kong out of the equation, right? Let's say it's a horse race. Hong Kong is wings. Get rid of wings and look at the rest of the field. And I think the Commonwealth Games of house prices collapses will be Canada will get the gold medal, Australia silver, New Zealand the bronze. Name your price for the rest of the field. But hell, get the hell out. Don't listen to all these mainstream economists who have got no idea. She'll be right, mate. What a complete load of rubbish. And your figures are probably, it's the most valuable information I've ever seen. You've certainly taught me a lot. And if you're in a bit of doubt, as I said, just get the hell out.
Mm. Yeah, well, I'm a great believer in data because, DFA is all about data and information and showing people what's going on without sort of, if you like, a slant of a spin on it, right? So, people sometimes accuse me of being negative all the time. Well, that's because the data's negative at the moment. That's why I'm painting the picture that I'm painting, because that's what the data is saying. So at least people should understand that there are sources of information like DFA and like your own views. There are people who are actually really calling it as it is. But it is hard for many people to separate sheep from goats and to understand why it is that all the mainstream guys are still saying everything's fine. Well, there's other agendas running. Go with the data, but once you begin to realise that there are issues, there are things that people can do even now to perhaps buttress, for the impending issues ahead. And I guess that's what I try to say to people is it's never too late to actually start planning and start thinking and start taking steps to be able to actually deal with some of the risks that you could potentially be facing. But time is short now.
Well, I guess if you don't listen to DFA, you'll end up with SFA. So people got that choice. But I'm just telling it how it is. As I said, I've struggled with my own balance sheet. I know I follow the real estate market. There's something's out of whack. There's no new paradigm in Sydney. Sydney, in my opinion, no offence, is a bit of a shithole. You look at look at these areas. I hate it. I mean, coming out of the last recession, I was a police officer. I dealt with social issues. I was able to buy a unit in Bondi Beach as a first home buyer, for God's sake. There's no, 3 times, actually I paid 2.4, but 3 times earnings now to 18 to live in an overcrowded area with full of hipsters. No offence, I probably insulted everyone, Martin, but I'm just telling it how it is.
Well, Tony, it's good to catch up with you again and to get your perspective. And, you never hold back, which is good because I think people need to hear it as it is. So I appreciate your time tonight. Is there one last point that you'd like to leave with people as we close this conversation?
I think, look, listen to what we're saying. I'm fairly confident what's happening. Viewers should know that when it's going to be a buy, you're going to call it a buy. You're not this total doomsday merchant. I've got lots of ideas how to make money, on how to survive, and I'm happy to do a future interview to tell people how to do it.
We should pencil that in for a little while down the track, because people now are saying to me, okay, yeah, we get that there's an issue, but working out what to do next is actually way more complicated. So we should come back and pick that up in the future episode, Tony.
Okay, look forward to it.
Thanks for your time today. Appreciate it.
Pleasure. See ya.
So there you have it, a very important message from Tony, that things are looking a bit shaky. And just to re-emphasise, DFA uses data to inform the debate, and if the news does get better, of course, we'll go positive. But unfortunately, at the moment, most of the news is on the downside. I'm Martin Wolf from Digital Finance Analytics. Many thanks for watching, and I'll talk to you again next time.